Hey everyone, and welcome to This Explainer. Today, we're diving straight into the fascinating, fast-paced world of real estate and co-living. We're going to unpack the first half financial results for the 2026 financial year for Coliwoo Holdings. I'm your strategy analyst.
And I'm your numbers expert. We're putting on our investor hats today, folks. We don't just want to know how much money Coliwoo made. We want to uncover exactly how they made it and what their roadmap looks like moving forward. They've built this highly successful model where they take unused or older properties in Singapore and transform them into really trendy communal living spaces. And honestly, their recent performance, it absolutely warrants a closer look.
So to kick things off, let's think about the absolute biggest headache for any property business: empty rooms. They mean zero revenue. It's just the ultimate drag on margins. So the crucial question to really anchor our analysis today is, how in the world does a real estate company keep its rooms almost completely full, month after month, especially in a fiercely competitive market like Singapore?
Well, the secret is entirely in the numbers. They've hit a staggering 97% average occupancy rate across their whole portfolio. And just to put that into perspective for you, we're not talking about some little handful of boutique apartments here. This is a massive operational footprint. They have grown to over 3,500 rooms.
Right. 97% is just wild. Maintaining that kind of rate means their flexible, community-focused living spaces are hitting an absolute sweet spot. It shows massive consumer demand, and, maybe more importantly for us as investors, it shows incredibly tight operational execution on the ground.
Okay, Section 1, Coliwoo's strong financial half. Let's get into the scoreboard.
The sheer top-line growth here is, well, it's impressive. In the first half of last year, they brought in roughly $23 million. Fast forward to this year, that figure has jumped to $26.8 million. That's a surge of nearly 17%. Exactly. And this growth is largely driven by their newly launched properties finally operating for a full reporting period, combined with those remarkably high occupancy rates we just talked about. Plus, they even declared an interim dividend of 1 Singapore cent per share. For shareholders, that's a really strong signal of confidence from the management team. But you know the old saying, revenue is vanity, profit is sanity, right? Well, the adjusted net profit for shareholders is sitting at a very healthy $8.6 million.
Right. And just to be super clear for everyone listening, adjusted net profit is an incredibly helpful metric. It strips out all that one-time accounting noise, things like the cost of going public or paper changes in property values. It basically gives us a pure, unadulterated look at how much actual, real cash the core business is generating day to day.
And that core operational profit rose by 14%. So this proves they aren't just growing revenue for the sake of top-line vanity. They're actually maintaining really healthy, sustainable operational margins while they scale up the whole shebang. So where is all this money actually coming from? Let's break it down. The biggest chunk by far, $19.1 million, comes from properties they lease and then rent out. Then properties they own outright generated $3.7 million.
But honestly, the really fascinating piece of the puzzle here is the management services segment. That brought in $2.3 million.
Yes, that specific segment saw a massive 44% jump compared to the same period last year. They secured this major new management contract with a transport operator, which really boosted this category. And as an investor, that's what you want to see. It proves they can generate serious revenue not just by buying or leasing buildings, but just by managing the operations for other owners. Which leads us perfectly to a really interesting pivot in their strategy. They're making solid profits, the rooms are consistently packed, their properties are highly valued. So the million-dollar question right now is, why are they suddenly looking to sell off some of their absolute prime real estate?
That brings us to Section 2, selling to grow faster. Let's use a quick analogy. The old school way of doing real estate is incredibly heavy. You buy a whole building and boom, all your cash is instantly tied up in bricks and mortar. You essentially have to sit around and wait years to build up enough capital to buy your next one.
Right, but the new way, this asset-light way they're moving towards, is all about maximum agility. Instead of owning the building outright, you manage it for someone else, or you rent it on a master lease and sublet the rooms. You keep your cash totally liquid. You can take the money you would have spent buying just one building and use it to lease and operate 5 different buildings. You scale your footprint so much faster. And honestly, from an investor perspective, this asset-light approach really helps mitigate risk during market downturns, because you're not sitting on heavily depreciating assets.
And they aren't just talking about this theory in boardrooms, they're aggressively executing on it.
They recently put up a portfolio of 7 freehold assets for sale, carrying a massive combined price tag of $218.5 million.
Yeah, these are fully stabilized, super profitable properties in dynamic city fringe districts like River Valley Road and Ballestier Road. By selling these right now, they are cashing in on peak market valuations. They're unlocking a tremendous amount of liquidity, taking the value they built up and turning it directly back into raw, deployable cash to fuel their next phase of hypergrowth.
Exactly. And that cash won't just be sitting idle. It's being channeled directly into higher-yielding opportunities. First up, master leases, renting entire buildings to operate under their brand. Second, more management contracts, kind of like the one that just boosted their service revenue by 44%. And third, selective acquisitions of mispriced assets, where they can add immediate, tangible value by converting them into modern co-living spaces. Basically, they're putting every single dollar to work.
Moving on to Section 3, Market Outlook and Risks. What's on the horizon?
The biggest tailwind right now is the sheer volume of people entering Singapore. Based on the Tourism Board's data, last year saw 16.9 million international arrivals. For 2026, projections show that jumping to between 17 and 18 million.
And keep in mind, it's not just casual tourists here. We're looking at a very strong lineup of business events, international conferences, and massive exhibitions. All these inbound travelers need a place to stay, and a lot of them are specifically hunting for the exact type of high-quality, flexible accommodation that Coliwoo provides.
Furthermore, the broader rental environment in Singapore is working strongly in their favor right now. Recent government data shows that private condominium rents are actually edging up again after a brief period of cooling off. The supply of top-end housing is tightening significantly.
And when traditional renting becomes way more expensive or just harder to secure, flexible co-living spaces become an even more attractive, viable alternative for farm professionals, students, and corporate tenants.
But as investors, we absolutely have to weigh the risks. If severe economic downturns tighten corporate travel budgets globally, or if tourism cools off unexpectedly due to macro shocks, well, that massive demand could soften. That's a baseline risk for literally any hospitality business that relies heavily on inbound traffic.
All right, Section 4, the road to 10,000. This is the big number right here, 10,000 rooms. Coliwoo's stated goal is to more than triple its current room inventory to 10,000 rooms by the year 2030.
I mean, that is a truly massive growth trajectory. Going from roughly 3,500 rooms today to 10,000 in just a few short years, that requires incredible financial discipline, flawless execution on the ground, and a very, very clear vision.
But here's the thing. They aren't just pulling numbers out of thin air to sound impressive. Their roadmap is already heavily underway with concrete, tangible projects.
Right. Let's walk through the timeline really quick. In the third quarter of this year, they're launching a major resort-style project at Jalan Loyang Besar with 380 rooms. By early 2027, a huge property near Changi Business Park comes online. Then King George's Avenue later in 2027 and Armenian Street in early 2028. The pipeline is completely packed and moving forward rapidly.
And to actually hit that 10,000 room goal, they have to look beyond Singapore. They're actively targeting high-growth gateway cities across the Asia-Pacific region. We're talking places with strong corporate demand, rising rental costs, and massive urbanization trends. Crucially, though, they're sticking strictly to their asset-light structure in these new territories. They're utilizing master leases and joint ventures. The game plan is to find under-optimized hotels and commercial buildings in other countries and export their successful conversion model.
Though we should definitely call out the execution risk here. Entering foreign markets means navigating complex new regulatory environments, battling entrenched local competitors, and adapting to entirely different consumer preferences. Exporting a successful domestic model is never a guaranteed slam dunk for sure, and investors will be watching this expansion very, very closely.
So, to summarize everything we've unpacked today, Coliwoo has delivered an incredibly strong first half of the year. Revenue is up almost 17%. Core operational profits are up 14%, and their rooms are virtually fully booked at 97% occupancy. But more importantly for the long-term investor, they aren't just resting on their laurels. By launching a $218.5 million portfolio sale, they're actively transitioning to a highly scalable, capital-efficient business model. So the real provocative question we want to leave you pondering today is, just how quickly and effectively can they execute this ambitious asset-light vision as they expand globally toward that 10,000-room target? This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.